Are you looking to get started investing? Well, in this video, I'm going to show you the smart way to invest your first $10,000. Welcome back to Chris Dunn TV, the show that's all about teaching you practical skills to thrive in today's economy. And make sure to subscribe so you don't miss any future videos. So I got this question from Chris S. He said, I've been looking to invest some money, but I don't really know where to start. Do you have any suggestions? And this is a common question that I get all the time, so I decided to dedicate a whole video to it. And I'll start by saying this. I'm not a financial advisor and I don't manage other people's money. I just manage my own money. And so you may be starting with way less than $10,000 or way more than $10,000, but I think 10K is kind of a good round number to start with because it'll help us look at some scenarios of how to allocate those funds in a really smart way. And before we dive into the different ways to invest, I think we first need to really define what investing is, because a lot of people get investing confused with saving and with speculation. And the best definition of investing that I've ever heard is from a guy that I really respect, Cullen, who is the author of Pragmatic Capitalism. And I will link up the interview that I did with Cullen a while back, both up here and in the show notes. So I reached out to Cullen and I asked him to give me a quote for the purposes of this video for what investing really is. That way we can properly define it before we start making plans. And this is what he had to say. He said, true investment means spending on things that will enhance our future production. While most of us have been trained to think that we quote unquote invest in stocks, the reality is that most of us are simply reallocating our savings. Okay, so this subtle but important difference places the focus where it should be and helps one differentiate in their life where they should either be spending to enhance on their own future production or allocating savings in a safe and prudent manner. So to help us further define and recognize the differences between investing, saving, and speculating, it's really all about the goals, okay? So for example, the goals of investing, as Cullen's quote said, is you use capital to produce something. You take money, you invest it somewhere, and it creates something new in the world that will hopefully give you an ROI in the future. On the other hand, the goal of saving, there's really two goals that Cullen likes to talk about. The first one is you want to beat the rate of inflation. So let's say that inflation is 2 or 3% a year. In your savings, your goal should be to beat that and also to avoid permanent loss. So for example, if you save in the stock market, if you have a 401k or an IRA and you're just putting money in the stock market as a place to save for retirement, where you're going to keep that money for 20, 30, 40 years and not really touch it, you're going to have down days, weeks, months, and years. But the idea is to never incur a permanent loss, right? Over time, you want to beat inflation, and over time, you want to avoid any permanent losses, which is why a lot of people actually lost money in 2008 is because they actually bailed at the bottom, right? When the market came crashing down, everybody freaked out and sold. If you were holding or saving for the long term, that really, looking back over the past decade or so, is a non-event because the stock market rebounded so quickly. And then finally, the goal of speculating is where you are looking to quickly and exponentially grow capital while attempting to manage very, very high risk. So speculating at kind of its fundamental level is really just educated gambling, right? You are placing money on a high risk scenario. It could be day trading the stock market or, betting on horses, whatever. When you are making a speculative bet, you are using some form of analysis, hopefully, or you're just using it for entertainment where really you're just a gambler. So again, the main difference between investing and saving, you're taking capital to actually produce something in the future. So an example of that would be if you took money and you invested in a startup, right? If you gave money to an entrepreneur who was, say, going to build a software program and build something new, where if, let's say, you bought some shares of Apple, or when Facebook IPO'd, you bought some shares from Mark Zuckerberg, he's the one that actually made the investment in Facebook, and you are essentially purchasing his investment as long-term saving. So when it comes to investing and saving and speculating the smart way, there's actually 5 different areas that you can allocate your capital. And again, we'll use the example of $10,000, but you may have less or more. But I think the first step in this, and this is what I think should be a minimum fixed number, is an emergency fund of at least $2,000 cash, meaning cash money, or in a easily accessible checking account. And before we go any further with this, I think it's so important to talk about this emergency fund because I recently became aware of the fact that most Americans have less than $1,000 in their savings account. This is like total net worth. This is actually really scary to me. You know, approximately 62%, or basically 2/3 of Americans, have less than $1,000 in their savings accounts, and about 20%, or 1 out of 5 people, don't even have a savings account. And I think the reason why this emergency fund is so important is because life gets in the way. Unexpected things happen. Your car can break down. You can have an unexpected emergency medical bill, right? So when you need this cash, you need access to this cash. And then the second way to allocate your capital would be what I call a freedom account. Basically an account where your goal could be to have 12 months of living expenses easily accessible. So if you're stuck in a job that you hate and you're thinking about making the jump into entrepreneurship, and what this does is it gives you freedom, right? It gives you freedom to make choices that are not based on fear. Where if you're living paycheck to paycheck, you might have to stick with a job that you hate because the other side of that is you're not going to be able to eat, right? So if you have a freedom account with 12 months living expenses, you're going to have a lot more options and flexibility. And then the third step is long-term savings, right? This is what people sometimes call a retirement account, or the nest egg, long-term savings, where you're going to look for low-fee, diversified, very boring investments that you hardly ever touch, right? And I think this is important, so you're planning for the future. Now, step 4, this is where we actually start talking about real investment, right? And there are several different areas you can invest. I think the best investment is yourself. The second best investment is a business that you own. And then the third best investment could be cash flowing real estate, right? An asset that isn't just like gold sitting in a closet. It's an asset that you own that actually brings in income. Also venture capital, like I mentioned earlier, startup seed money. That's why I'm an angel investor. And then number 5, this is where we finally get to speculating. This is where you're actively trading financial markets. This is where you're flipping real estate. Maybe you're doing a fix and flip, right? I have one that I'm almost done with. So again, 5 different areas that you could put your money. And here's how I'd actually allocate my first $10,000 if I were starting over today. The first, I would have $2,000 in emergency fund, right? We talked about that, either cash or in an easily accessible checking account. The second would be your freedom account. I would put $3,000 or 30% of your funds towards your freedom account. And basically I would put this in, and this is kind of a joke now, high interest savings accounts, right? Maybe you're going to get 1% or 1.5%, which you're still not beating inflation over the long run. But again, this is your freedom account that even though you might lose a little bit to inflation over time, these funds are really there to give you freedom and to give you the ability to make fearless decisions. And now the third step here is really going to depend on where you are in life. The goals for an 18-year-old are going to be significantly different than the goals of a 65-year-old, right? So if you're somebody who's relatively young and you have a lot of time towards retirement, then if I was starting with 10K today, I would really only put maybe 10% of that towards long-term retirement, because again, that's going to be kind of slow, boring, and grow steadily over time. So I'd put maybe $1,000 towards long-term savings, again, diversified value investing, right? Just something that is super long-term that you're not really going to touch. And then I would put 3K or 30% of that 10K towards investing. And you need to really invest wisely here, right? You could invest in your own education. You could invest in a bootstrapped business, meaning a business that you start from scratch where you don't raise any capital and your goal is to create income, possibly replace your income relatively quickly. And then finally, the last thing is speculating. I think if you're just getting started with a little bit of money, maybe only 10% of those funds should be allocated towards speculating, right? These are basically your high risk Hail Marys, right? Trying to actively trade the financial markets, trying to do really aggressive real estate deals, right? Anything where the risk of permanent loss is very high, that is speculating. Well, you might be saying, well, Chris, what about that guy that turned $1,000 into $5 million? Why wouldn't I just want to take all 10K and put it towards something super aggressive and then just get rich really quickly? And look, those stories do exist, but there's something that we really need to pay attention to, and that's called survivor bias, okay? Survivor bias, defined by Wikipedia, I kind of chopped this down into my own words. Survivor bias is the error of concentrating on the people that survived some process, meaning you focus on the few people that made it and you inadvertently overlook those that did not make it because of their lack of visibility. Basically, they fade into the background, right? In other words, you don't hear about the 99.99% of people that failed. And this is the reason why I stopped doing videos on day trading the rigged stock market, because no matter what I did, and I was in this industry for a long time, no matter what I did or no matter what strategy anybody else was using, no matter what market you were trading, time frame you were trading, if you were actively day trading the stock market, 99% of people were losing money for a multitude of reasons that I'm not going to rant about in this video. But when it comes to high risk speculation, again, guys, I would really encourage you to think about the things that are going to give you a 90% chance of success, not the Hail Mary where 1 in 1,000 actually makes it. Okay, so after you've funded your emergency account and your freedom account, what would you do with your money? Okay, so kind of taking this to the next step, here's what I would do. And again, these percentages are going to vary based on things like your risk tolerance and your personality. But if it were me, I would put maybe about 60%, roughly 2/3 of my monthly cash flow into investing, right? Things that are going to produce something with an ROI in the future. That might be more education or mentorship. It might be investing and scaling your business. It might be investing or partnering with somebody else in another business, right? The second step, I would put about 30% into long-term savings, right? Growing your wealth for the long term. And then even after your emergency funds are there and after your freedom account is there, I would still, and to this day, this is what I do, I only keep about 10% of my funds available for high-risk speculation. And yes, that does include trading cryptocurrencies, because even though I believe in cryptocurrencies and I think digital currencies and currency competition is great for the global economy, I think it is still highly risky, super speculative. So the last thing I want to hear about is somebody saying, oh, Chris, I swung for the fences. I put all my money into this cryptocurrency that blew up, or I lost my coins or something, right? So no matter what you work these percentages out to be, whatever you find these to be best for you, just plan in advance, right? Be very pragmatic about it, be very methodical about it, and you're going to win over the long term. So I hope this episode was helpful, guys. I have a question of the day for you, and I want you to leave a comment below with what investment has given you the absolute highest return to date. Okay, so answer that below. Feel free to share this video with anybody that you think it would help. Don't forget to subscribe, and I will see you in the next video. Take care.